Part 5C introduces cross-rate trading in foreign currencies. I will also explain how traders can profit by taking advantage of triangular arbitrage opportunities. A list of the specific topics that we will cover is included on this slide. The term currency against currency trade refers to an FX trade between two currencies, neither of which is the dollar. For example, consider a bank customer who wants to trade British pounds for euros. This would be a currency against currency trade. The interesting thing is that these trades typically go through the dollar. So our customer who wants to trade pounds for euros would actually first sell pounds for dollars and then sell dollars for euros. You may wonder why banks handle currency against currency trades in this way, and there's a good answer to that question. You'll find it on page 125 of your text. Be sure to take a look. Currency against currency trading is handled by the bank's cross-rate desk. Let's begin our discussion of cross rates with a very simple example that ignores bid-ask spreads. Suppose that the dollars per euro spot rate is $1.50, which implies that 1 euro costs $1.50. At the same time, the dollars per pound spot rate is 2.0, implying that 1 pound costs $2. Given these rates, what would the pounds per euro cross rate equal? Well, in general terms, the equation for the cross rate is provided here. Note that the dollar values cancel each other out, leaving the pounds over euro ratio. Using the rates provided, we can calculate the actual cross rate, which I've provided here. We find that 1 euro cost 0.75 pounds. Now, let's take a more realistic approach by incorporating the bid-ask spread into our cross-rate calculation. Again, assume that the customer wishes to exchange pounds for euros. The table provides the American and European term quotes for the pound and the euro. Our job is to use this information to calculate the euros per pound cross rate, and we want to know both the bid and the ask. Let's first determine the euro to pound bid rate. To keep the math simple, suppose our hypothetical customer has 1 pound and she exchanges it for dollars. The dollars are then exchanged for euros. Note that in the first step, pounds to dollars, the dealer is buying pounds, the asset, with dollars. Thus, the American term bid for the pound is the correct rate to use. In the second step, the dealer is buying dollars, the asset, with euros. Thus, the European term bid rate is the correct rate to use. By the way, you could also use the reciprocal of the American term ask rate here. Can you explain why? Calculating the final product, we found that the cross-rate bid price is 1.1763 euros per pound. We can enter this value in the appropriate column in the table. And there it is. We can also fill in the European term ask price for the cross rate. Simply take the reciprocal of the value that we just calculated. The pounds per euro ask price is 0.8501 pounds per euro, and I've added that to the last column of the table, and there's the calculation kind of on the side at the right. Now let's complete the table starting with the pounds per euro bid rate, which is in the third column of the last row. This time, suppose the customer has 1 euro, which she exchanges for dollars, and then she exchanges the dollars for pounds. In the first step, the customer has 1 euro, which she exchanges for dollars, and then she exchanges the dollars per pound. In the first step, euros to dollars, the dealer is buying euros, the asset, with dollars. Thus, the American term bid rate for the euro is the correct rate to use. In the second step, the dealer is buying dollars, the asset, with pounds. Thus, the European term bid rate should be used. Or you could use the reciprocal of the American term ask rate. It's the same thing, right? Okay, so there's our value. The last step is to determine the American term ask price for the cross rate. simply take the reciprocal of that value, 0.8495 pounds per euro, take the reciprocal of that, and there's our calculation, and you get the euros per pound ask price of 1.1771 pounds per euro, and we've added that to the table as well. So now we have all of the bid-ask cross rates in both American terms and European terms. This slide simply summarizes all our cross rate calculations. Note that the reciprocal relationship also holds for cross rates. For example, the reciprocal of the euros per pound bid is equal to the pounds per euro ask. Also, take a closer look at the bid-ask quote for the euro to pound. The spread is 0.0008, which is larger than the bid-ask spread for the dollars per pound or the dollars per euro American term rates in the first two rows. This is typical because cross rates implicitly incorporate the bid-ask spread on the two transactions needed to conduct a currency against currency trade. Some banks offer direct trades between non-dollar currencies at a lower bid-ask spread than the cross-rate spread. This can lead to a specific type of arbitrage opportunity. You may recall from previous courses that the term arbitrage refers to a zero-risk, zero-investment strategy that yields a guaranteed profit. In the case of currency against currency trading, sometimes traders can profit from triangular arbitrage opportunities. Triangular arbitrage involves trading US dollars for another currency and then trading that currency for a third currency. The third currency is then traded for US dollars, yielding a profit. Triangular arbitrage profits result when the direct exchange rate between the second and third currencies does not equal the cross exchange rate. These opportunities must be acted on quickly by traders because banks offering a direct rate are likely to adjust their quotes quickly when they realize the misalignment with the cross rate. Here's an example of a triangular arbitrage opportunity. Suppose that three banks are quoting the rates shown here. Note that Crédit Agricole is offering a direct market between the euro and the pound. The last row of the table provides the euros per pound cross rate that has been calculated using the Deutsche Bank and Credit Lyonnais quotes. At the bottom of the slide, I've shown how to calculate the cross rate bid price. For practice, you should calculate the ask price. If Crédit Agricole's direct rate equaled the cross rate, there would not be an arbitrage opportunity. Hence, the cross rate is equivalent to the no arbitrage rate. Note that the bid-ask spread for Crédit Agricole's direct rate is smaller than the spread for the no arbitrage cross rate. More importantly, note that Crédit Agricole is offering to sell 1 pound for 1.1760 euros. At the same time, the cross rate bid for a pound is 1.1763 euros. So how could a savvy trader exploit this fact? Here's how to profit via triangular arbitrage. By going through Deutsche Bank and Credit Lyonnais, the trader can sell pounds for 1.1763 euros per pound. Again, this is based on the calculation of the cross rate bid as shown by the equation. The arbitrage opportunity stems from the fact that Crédit Agricole is offering to sell pounds for only 1.1760 euros per pound. So the trader could buy pounds from Crédit Agricole at the lower rate and then sell them at the cross rate, which is higher. Here are the steps a trader with 1 million pounds at her disposal could take to conduct a triangular arbitrage. So let's just take this as a sort of hypothetical. First, sell the pounds to Deutsche Bank for $1.54 million. And there's the calculations. So note that Deutsche Bank is buying pounds, so we'll use the bid rate there. Note that this is based on the Deutsche Bank bid rate. Then the trader takes her dollars to Credit Lyonnais and uses them to buy euros. Note that Credit Lyonnais will be buying dollars, so we use the reciprocal of the American terms ask rate to get the European terms bid rate. The trader then receives
1,176,291 euros. The last step is to sell the euros to Crédit Agricole for pounds. Crédit Agricole will be buying euros, so we use the reciprocal of the euros to pound ask rate to get the pounds per euro bid rate. The trader receives £1,247 and change. Note that she started with £1 million. Thus, her profit is £247.45, and all she did was take advantage of an arbitrage opportunity. Note that the triangular arbitrage opportunity exists because of a disequilibrium in the FX market. The discrepancy between the cross rate and Crédit Agricole's direct rate won't last for long. Triangular arbitrage opportunities, as I said before, must be acted on quickly. Now, lastly, on page 127 through 129 in your textbook, you will find a summary of the research on the microstructure of the spot FX market. Please read these pages carefully, making special note of the research findings listed on this slide. Okay, that wraps up our coverage of parts 5A through 5C. We will complete part 5D together in class on February 16th, and I look forward to seeing you then.